These trade figures paint a mixed picture. On the good side, exports are up 0.5% compared to this time last year, but that's slightly more than a lot of pundits had expected. And given that exports have played such an important role in Chinese economic growth over the past 20, 30, 40 years, that's good news. The bad news is that imports are down. Now, they're down compared to a year ago. And a year ago, China was in a very, very difficult state. There were some very, very strict COVID rules in place. A lot of people, hundreds of thousands, millions of people even, were locked down from time to time. Cities basically stopped working. Factories were closed because of COVID, to stop the spread of COVID. Now, China removed those restrictions and the economy was supposed to roar back early this year, and on the whole it hasn't. So if China is importing less than a year before, that's not good news. It suggests that factories might not be buying as many raw materials to turn into things to sell, either to export or sell to Chinese people, so that's not good news. And if you take into account other statistics as well, they paint not such a good picture too. China's factories seem to be getting less busy rather than getting busier. Inflation figures suggest that prices are probably falling. Again, that's not a healthy sign. Deflation's not a healthy sign for an economy. And the latest outlook from Moody's, the credit rating agency, is negative. In other words, it's suggesting that the risk of lending money to China by buying its government bonds and so on is likely to increase perhaps over the next 6 months or so, because China's probably going to have to borrow an awful lot more money in order to stimulate the economy back to thriving life. In Hong Kong, I'm Andrew Wood, reporting for SABC News.